China's venture capital industry is undergoing significant changes. Since the end of the zero-COVID policy, more American investors have been leaving China, and the flow of American funds into Chinese startups has been drying up. According to data from PitchBook, which tracks startups, the transaction involving Chinese startups, including those with American investors, dropped by 88% from $47 billion to $5.6 billion between 2021 and 2023. This starkly contrasts with the situation 20 years ago, when American investors flocked to China. 20 years ago, Silicon Valley Bank led the first group of 25 American investors to visit China, where they received a red carpet welcome. Sequoia Capital started investing in China in 2005. According to Bloomberg, Doug Leone, Sequoia's CEO at the time, visited China for the first time that year and was greeted with a red carpet and saluting guards as he met with top Chinese officials. Following this, Sequoia and other venture capital firms set up branches in China. Sequoia alone has invested in over 1,200 Chinese startups. However, in 2023, due to geopolitical tensions, Sequoia spun off its China operations into a separate entity, Sequoia China. The increasing geopolitical tensions have led to more restrictions from both the U.S. and China. Washington is tightening its scrutiny of U.S. investments in areas like semiconductors, AI, and quantum computing. For example, U.S. venture capital firms like GGV Capital, GSR Ventures, Qualcomm Ventures, and Walden International were investigated by a U.S. congressional committee in 2023 for their investments in sensitive Chinese technologies. Many U.S. venture capital firms have scaled back their investments in China. Some have separated their Chinese operations from their U.S. operations, and some have stopped new investments in China altogether. U.S. venture capital firms are pulling out. According to research firm Dealogic, foreign investment in China's venture capital sector plummeted by 60% to $3.7 billion in 2023, just 10% of the peak in 2021. The South China Morning Post reports that both industry insiders and market data indicate a major shift in China's venture capital industry, with the long-standing relationship between American investors and Chinese startups coming to an end. NYU law professor Jerome Cohen notes that the cycle has been broken and that the gap between U.S. funds and Chinese tech startups will continue to widen. In this context, despite Beijing's ongoing signals to welcome foreign investment, the response has been lukewarm. Mr. Liu, who is involved in U.S. cross-border investments, said American investors take risks to their country seriously. They won't be swayed by mere statements from the Beijing government. They observe actions over long periods. For example, local governments and state-owned enterprises in China have become major players in the venture capital industry. According to Chinese research firm 02IPO, by 2023, China had established 2,086 government-guided funds with a target size of 12.2 trillion yuan and committed capital of about 7.13 trillion yuan. However, the expansion of state-backed funds has sparked debate about the future of China's venture capital industry, as these funds tend to avoid risks and prioritize local investments, fundamentally changing the industry's commercial landscape. Meanwhile, the state advances while the private sector retreats. This has accelerated the withdrawal of market-driven capital. In a recent speech, founding partner and CEO of China E-Capital stated that China's primary capital market is dead because government funds, which dominate the market, are highly sensitive to any losses. For global investors in the Chinese stock market, the latest data released by the Chinese government has only added to their frustration. On July 15th, the Chinese National Bureau of Statistics reported that the country's economy grew by 4.7% in the second quarter, marking the slowest growth since the first quarter of 2023. The series of measures implemented by the government have done little to restore consumer confidence in China. The data also showed that in the first half of this year, real estate development investment fell by 10.1%, and the sales area and sales volume of new commercial housing nationwide decreased by 19% and 25% respectively. The struggling real estate sector shows no signs of improvement and continues to drag down the economy. Reuters mentioned that China still has a long way to go to achieve any meaningful recovery and boost the stock market, which has risen by just over 1% this year. Earlier this year, the Chinese government introduced a series of support measures to try to prop up the sluggish stock market, resulting in a brief market rebound. However, months have passed, and the instability of China's economic recovery and the lingering real estate crisis remain unresolved. Many real estate developers still face the risk of liquidation. Meanwhile, geopolitical challenges like trade frictions between China, Europe, and the US further hinder China's economic recovery. The deteriorating investment environment in China has not only led to a continuous exit of international venture capital, but also affected related service industries. Several American law firms have recently announced the closure or reduction of their operations in China. For instance, Weil, Gotshal and Manges, LLP, one of the largest international law firms headquartered in New York, established a Shanghai office in 2004 and a Beijing office in 2008, but decided to terminate its China operations in April this year. On July 4th, the Chinese Ministry of Justice announced the cancellation of Weil's Beijing office license and the revocation of its practice license. In early July, Detcher LLP announced it would completely exit the Chinese market by the end of the year. In early May, Sidley Austin LLP, the sixth largest law firm in the U.S., announced it would not renew its license for the Shanghai office. Former President Obama and his wife once worked at Sidley Austin. Another large American law firm, Mayer Brown, also plans to divest its current Hong Kong operations. In the first half of this year, other American law firms announcing closures or plans to close their China offices include Aiken Gump Strauss, Hire & Feld, Perkins Coie, Orrick Harrington and Sutcliffe, and Latham & Watkins. Additionally, among the 73 largest American law firms in China, 32 have reduced their number of lawyers over the past decade. Among the 48 largest American law firms in Beijing, 26 have reduced their number of lawyers since 2018. Data from the Chinese Ministry of Justice shows that overall, the number of foreign law firms with representative offices in China decreased by 16% from 2017 to 2022. Former Chinese lawyer Liang Xiaohua, who now resides in the U.S., analyzed that the primary reason for this is the decoupling effect, which refers to the economic separation between China and Western countries, leading to a lack of work for foreign law firms in China, prompting their gradual withdrawal. In recent years, China's economic coercion and military expansion in the East China Sea, Taiwan Strait, and South China Sea have provoked backlash from Western countries led by the U.S. Risk reduction and decoupling have become strategies for countries to counter the threats posed by China. Foreign law firms in China typically have two types of clients: subsidiaries or branches of multinational corporations and Chinese companies expanding overseas. Their main business involves high-end non-litigation services related to foreign investments, including mergers and acquisitions, overseas listings, international litigation and arbitration, technology transfer, and intellectual property protection. Liang Xiaohua stated that in the past 10 or 20 years, when trade between China and the West was good and China's economy was developing well, many companies wanted to go abroad, such as listing in the US and Europe, mergers and acquisitions, and making investments. At that time, law firms that were familiar with foreign laws and provided Chinese resources did well. But in recent years, as China's economy declined, and now with discouragement from going abroad, many companies are struggling to survive and cannot afford to invest or acquire abroad. The significant drop in international business means that foreign law firms have little business in the area. On the other hand, Liang pointed out that China's legal environment has become increasingly harsh. Many things cannot be done just by understanding the law or following legal procedures. Hidden rules and shady operations have become more severe in recent years. Additionally, the Chinese government has passed new laws, such as the anti-espionage and the national security law. The trend of these laws is becoming increasingly unfriendly and terrifying for foreigners and foreign capital. In March 2023, Chinese police raided the Beijing office of the American Investigation Group, detaining 5 employees. In April, the Chinese State Security raided the Shanghai office of management consulting firm Bain & Company. In May, they raided the offices of consulting firm Capvision. Chinese state television even reported on these incidents, accusing overseas institutions of colluding with domestic consulting companies to conceal their foreign backgrounds and circumvent Chinese laws and regulations. Liu Xiaohua stated that economic downturns make it hard for foreign law firms to earn money, and their executives, even middle managers and employees, feel unsafe. He explained that many law firms, whether doing IPOs or mergers and acquisitions, require extensive surveillance and investigation, needing to collect information. But with so many unclear restrictions in China, attempting to gather information or conduct investigations can lead to accusations of espionage or violating relevant laws and data security, resulting in potential arrest and sentencing. This personal safety issue has led many law firm executives to be reluctant to work in China. Regarding the withdrawal of foreign law firms from China, Peter Zughauser, founder of American consulting firm Zughauser Group, which advises global law firm leaders, told Voice of America that the main reason is the sharp decline in direct investment in China. Compared to 2 years ago, investment has dropped by 90%, leaving much less work for law firms. Recently, China's Ministry of Commerce announced that the amount of foreign direct investment in China from January to June this year was nearly 500 billion yuan, a decrease of 29.1% year-on-year. The actual use of foreign investment from January to May was 412.5 billion yuan, down 28.2% from the same period last year, continuing the decline that began in June 2023. Although Chinese data is often considered unreliable, a nearly 30% decline is very unusual for China, indicating that the real numbers may be even worse. Liang Xiaohua explained that if a law firm's business declines by half or even 90%, there's no reason for it to continue operating. Many employees would need to be laid off, and office space would need to be reduced. This is a steep, devastating decline. A former American lawyer in China, who would prefer to remain anonymous, told Voice of America that there are hardly any foreigners left at the International School of Beijing in Shunyi. Mostly Chinese children now. There are no foreigners on the streets, and it's hard to find any foreigners, let alone lawyers. Will this withdrawal from China continue? The British Chamber of Commerce in China recently published the 2024 recommendations for British businesses in China, indicating that this trend seems likely to continue. It largely reflects the increasing economic uncertainty in China, geopolitical tensions, and the deteriorating business environment for foreign businesses. Liang Xiaohua analyzed that China's disengagement from the outside world is a gradual process. Brokerages, financial institutions, and law firms are gradually withdrawing, signifying a continued severing of China's economic ties with the outside world. Even if one day the Chinese government realizes the need to resume its so-called reform and opening up and continue to attract foreign investments, it won't be something that can be quickly restored. The confidence has already been shattered, which will significantly impact Chinese companies' foreign financing and international trade for some time. In recent years, not only have many foreign law firms been withdrawing from China, but international accounting firms have also faced difficulties. For example, PricewaterhouseCoopers China has been heavily impacted by the collapse of Evergrande Group. This year, PwC China's accounting revenue from mainland-listed companies has dropped by about 2/3. On July 17th, the Financial Times reported that according to data from WindInfo, PwC China lost at least 561 million yuan in audit revenue from mainland-listed Chinese companies over the past 6 months. Last year, this audit revenue amounted to 869 million yuan. Earlier this year, the Chinese government fined Evergrande 4.18 billion yuan. PwC China, registered in Shanghai, had previously audited Evergroup and was subsequently investigated by Chinese authorities. Their partnership ended in January 2023. Bloomberg reported in May that PwC might face a fine of up to 1 billion yuan due to audit errors in the Evergrande case. Following this news, 21 Chinese listed companies, including financial institutions like PetroChina, PICC, China Merchants Bank, and companies like China Railway and China Merchants Port, terminated their contracts with PwC. According to WindInfo, PwC had 107 A-share annual report audit clients in 2023, with audit fee income exceeding 800 million yuan. By the end of May, at least 19 A-share and 2 H-share listed companies had canceled their cooperation with PwC. The audit fees for the 17 companies that disclosed their contract amounts exceeded 200 million yuan. The Financial Times reported that the significant loss of clients indicates that even the threat of penalties is reshaping China's audit landscape. The loss is severe enough to force companies to lay off employees and cut operating costs in China. On July 16th, Reuters reported that PwC, one of the Big Four international accounting firms, is considering cutting its financial services audit staff in China by half. This move comes as regulatory investigations and massive client losses have dimmed business prospects. Layoffs began last week and are expected to reach their overall target over time. Sources revealed that PwC currently has at least 2,000 employees in its audit department in China, mainly in Beijing and Shanghai. In addition to reducing audit staff, PwC also plans to cut 20% of employees responsible for non-audit services.